what are the steps that you go through if you want to start investing in Ugandan Treasury Bonds. Now, for those who don't know what Treasury Bonds are, this is when an individual, an institution lends money to the government the longer term, and that is either 2 years, 3 years, 5 years, 10 years, 15 years, or 20 years. And of course, it varies from different country to another, but on average, they are more or less the same. But for this video, I'm going to use a Ugandan context. Of course, my first assumption is the fact that you have decided to invest in Ugandan Treasury Bonds, but you're not sure where do you start from, and at the end of the day, where do you end up with. So the first thing that you have got to decide is which bank will you use to be investing your treasury bills and bonds. Because remember, you must have a commercial bank. You can only and only invest in treasury bonds if you go through a Ugandan commercial bank. So that will be a very big decision for you. Which bank are you going to use? The easiest way, if you already have a bank account here, you have to start with your commercial bank. Ask them, do they have this service? Can you buy and sell treasury bonds and bills through their bank? If yes, then you have hit a jackpot. But remember, all Ugandan banks are primary dealers. However, from personal experience, most of the customers, when they are visiting these banks and they're talking about dealing in treasury bills and bonds, they are not getting the right responses. So that implies that highly likely, yes, they're all primary dealers, but seems they are not serving the retail customers, all of them. So it's very good to first ask your bank and see, do they offer the service? If they don't, then that should not deter you from investing in treasury bonds. You just need to look out for another bank that actually does that service. I don't want to go into which bank do I use, which bank I have approached and they do these services, but my assumption is that all the banks have this service, but from experience, unfortunately, not all of them are receptive to retail customers. So it is about you looking out for different banks and confirm or determine which one works best for you. Because if yours does not work, if bank A is not being receptive when it comes to serving you for treasury bills and bonds, then try looking out for other banks. If they do, then that will be good. Or the other alternative, honestly, if there's someone out there who is working with one of these banks, and indeed your bank serves treasury bills and bonds customers, then please, you can highlight yourself here such that maybe some people can take advantage of that and also approach that specific bank. Because from personal experience, unfortunately, not all of them are serving treasury bills and bonds customers the way they claim they do. So it's quite unfortunate, but it is what it is. Just that other banks are extremely very good actually. So you just need to find out and see which bank is better than another. So it will be a very big decision for you, because at the end of the day, that is the bank you'll be transacting with. That's the bank you'll be buying with treasury bills or bonds. And that's the bank, in the event you want to sell, you'll be steering through. But also you have to remember, it's the same bank whereby if they're paying the interest, they'll be paying on the account that you have in that specific bank. So it's good to have some good relationship with them, especially if you know you're going to be doing this as often as possible. Like most of the time I advise, you can even afford to buy bonds every single month. So if you're going to be doing that, then obviously you need a good bank, but most importantly, you need a good relationship with that specific bank. So assumption is you have already chosen the bank. That's the first one. You have got to choose the bank that you'll be using, but you don't just choose on paper. You must visit them and be sure that indeed they can serve you, and if possible, develop relationships with specific people that you'll be dealing with, such that it's either just on a phone call or on an email, and they can work on you as soon as possible. Now, once the decision for the bank is sorted, of course, if it's your existing bank, you already have a bank account. If it's a new bank, it means you need to open up a new bank account. Now, up next, you need another bank account with the central bank. It's called the CSD account, or the Central Securities Depository account. This is your account with Bank of Uganda from the Ugandan context, but maybe different countries do it differently. But that account, you don't open it through the central bank, no. You open it through your commercial bank. So your commercial bank will help you to open that account in Bank of Uganda on your behalf. Now, it's a very simple document. It's just a 2-page document that you need to fill. Once you have filled that document, then all will be ready. In less than 2 to 3 working days, you will have that account, the CSD account, opened. Once you have opened up the CSD or the account with the central bank, now it is game time, but also it's decision time. It's about time now for you to decide which bonds are you going to invest in. If you remember, I'm not referring much to treasury bills because treasury bills, in all honesty, with the investors, the only reason why we want to lend the government is we want to get as much return or as much profit or as much interest as possible. When it comes to treasury bills, they don't have that much return or better interest that they pay on them. So I rarely, if not, I totally don't recommend someone to invest in treasury bills because remember, they have low return, but also they have a higher withholding tax of 20%. So if you feel like you want to invest short term, because these are treasury bills, they are either 91, 182, or 364 days. So if you feel you want to invest for such a limited period of time, from the return or from the profit or from the interest point of view, you are far better to say invest in a unit trust. Because why would you be investing in treasury bills when you're going to be getting a lower return? You get a lower return and also you are charged a tax of 20%. So that's why most of the time, me, when I'm talking about investing in government bonds, or if I'm talking about lending government, I'm focused on you investing in treasury bonds. And I'm so specific also that I want you to invest in longer term treasury bonds. That's 10 years and above, basically for 2 reasons. One, they always or usually attract a higher interest rate. And the second one, they have a lower withholding tax of just 10%. But if you are investing in a treasury bond that has a maturity period of less than 10 years, and this is the 2-year bond, the 3-year bond, the 5-year bond, those ones, on average, if you compare with the other ones, they always have a lower interest rate. But my only problem with them, they have a higher withholding tax of 20%. That's why I always recommend, if you want to invest in bonds, go for the longer term bonds. Otherwise, if you are going for the lower maturity bonds, you are far better for me to invest in a unit trust. Otherwise, we shall go to the next level. Now, the next level, it's decision time. That's where you're choosing. Do I invest in treasury bills? Do I invest in treasury bonds? And if I'm investing in treasury bonds, which maturity period am I investing in? Is it the 2 years? Is it the 3 years? Is it the 5 years? Is it the 10 years? Is it the 15 years? Or I'm going all through and I invest in the 20-year bond. Also, you have got again to make another decision. Are you buying these bonds through the secondary market or are you buying these bonds through the primary market? Now, what's the difference between these two? The primary market, and that's my favorite, this is when the central bank issues or sells the bonds to the general public for the first time. And the reason why I prefer it is because it is extremely simple process. It's very straightforward. All you need to do is to contact your bank in whatever way they agree with it. It might be physical, or you can do it remotely if the bank allows. And then the bank will put in your bid. And when the bid is accepted, hola, you finished. You have you have already invested in the treasury bonds. And remember, when it comes to primary bids, they start from 100,000 Ugandan shillings. That's the minimum. But if you go for an competitive bid, that is, if you want to invest any amount below 200 million Ugandan shillings, that bid is automatically accepted. What do I mean by automatically accepted? Because remember, on average, if the government wants to borrow, let me say, 400 billion Ugandan shillings, the people who want to lend it, maybe it might be 1 trillion or even 800 billion Ugandan shillings. So it's always oversubscribed. But the government created an avenue such that for individuals or for companies that have small amounts can also manage to participate in this process. That's why they made sure that for any amount below 200 million Ugandan shillings, your bid is always automatically accepted. However, if you are investing beyond 200 million Ugandan shillings, then there the game changes because now that's what we call competitive bid. So you need to state the rate at which you want to lend the government. Now, on average, you might succeed, but also on average, you might fail to succeed. So that's where it becomes extremely tricky because I always say that is now a game, or that's where the game for the big boys and the big girls is played, because at the end of the day, you have to be extremely calculative and extremely confident on the rate you're submitting. However, even if you don't succeed, if you're playing big beyond 200 million Uganda shillings, you can always buy from the secondary market. And that, of course, takes me to the secondary market. Now, this is a little bit different, because after the primary market, after the government or the central bank has issued the bonds for the first time to the general public, now some members or some companies that have bought those bonds can be selling other people within the secondary market. And of course, generally, that's why the biggest market is, because it means all bonds that the government has ever issued are up for sale in some way or another from the secondary market. So if you're bidding more than 200 millions, honestly, the secondary market can also work for you, because there you can get any amount of bonds that you want. But also, the other thing, it depends on your bank or on your advisors, because it's tricky. Sometimes the rates might be low, sometimes the rates might be high. I prefer the primary market because, as I have said before, it's extremely straightforward. But still, on the secondary market, you can get some good deals, but there you need an advice from your bank to guide you on the best way. So at the end of the day, don't go with my conclusion whether by the second or primary market. It's good to consult with your bank, have a conversation with them. They will guide you which market is the best market. Now, that takes us to the next time. You have decided you want either primary or secondary market. Your bank now will have to guide you. If you're going with the primary market, which is my favorite, the central bank, this is still in Ugandan context, the central bank always puts up a schedule, a 1-year schedule for the whole financial year, when they will be issuing which specific bonds. So you have 1 year to even see, okay, in January I will buy, in February I will buy, in this month I will buy. You can even decide far much in advance, but at least you are aware on the exact date that the central bank will be selling those specific bonds, and you can easily prepare yourself. Now, when it comes to the secondary market, that one is so simple. Any day you want to buy, just walk into the bank. They will advise you on the best bonds available, and you will be ready to transact your bonds. So I'm making an assumption that indeed you have gone maybe with the primary market or the secondary market. When it comes to the primary market, it is so specific. It always happens on a Wednesday, because in Ugandan context, every month, Bank of Uganda sells or issues treasury bonds, but it's always on a Wednesday. Now, after Wednesday, you will know on that Wednesday which rate your bond is going for. But on Thursday, that's when the money goes off your account. It's always important. This one, don't forget, please. If you want to bid, make sure the money you're bidding is on your bank account. For example, if you want to buy bonds for 10 million, make sure the 10 million is on your bank account. Now, on Thursday, that's when that money will go off your account. Always remember also that each bank can charge some transaction fees. It ranges from 5,000 onwards, but it's good to talk to your bank and see how much do they charge as a transaction fee if you're buying your treasury bonds. Once on Thursday it's done, then obviously you have invested in your treasury bonds. Now, up next will be you to ask yourself, how often do you want to do it? Is it a one-off that maybe you have 100 million and you buy it once? Or is it that you're going to be consistent buying every single month? Maybe you're investing 500,000 every month, 1 million, 2 million every single month. It's about you to decide. Once you decide, it's good to inform your bank such that you are up to speed and you are consistent with whatever decision you have made. That now takes me to another puzzle. Okay, I bought these bonds. What happens to the interest? Remember, bonds all around the world pay every after 6 months. Every after 6 months, they pay you the money. The interesting thing is that the annual interest is already known, but it's divided into two. Every after 6 months, half of the annual interest is paid for the rest of the lifetime of that bond. But now sometimes people wonder, how can I compound the interest that is earned from bonds? Unfortunately, it's not automated from the Ugandan context. If you compare it with unit trust, the interest compounds automatically. By compounding, I mean the interest is reinvested to earn more interest. For unit trust, it's automatic. Unfortunately, for the bonds, this is not automatic. Every 6 months, the net amount will come to your bank account. So you have to again, you yourself, reinvest it. That would mean either you're buying again a new bond that is being issued. If you are a primary market lover like me, you'll be buying a new bond that will be issued either the next month or that very month. Or if you want to go to the secondary market, you can even try to see if the same existing bond is still there, and you can buy it from the secondary market, or you can add, or you can just buy other better existing bonds. By better, I mean better interest rates. But bottom line, for treasury bonds, the interest does not compound automatically. You have got yourself to personally again go and then instruct the bank to buy new other bonds. That's the only way it will compound. Otherwise, it will be sitting on your bank account. So people always are confused. Can I withdraw the money? Absolutely yes, because the money comes to your bank account. Which bank account you can choose to use that money as you wish. Either you're going to spend it, or you get and invest in other things, or you reinvest and buy new bonds. So that will be really up to you. And those are decisions you need to make far early on before you start even investing. You need to know, okay, in 6 months' time, I've bought these bonds, I'll be getting the interest. What will I use this interest? Is it for my expenses? Is it for another investment? Or will I reinvest and buy new bonds? And remember, at the end of the day, there are situations which come and you want to sell off your bonds. It's never my advice, because at the end of the day, on average, when you're selling your treasury bonds, you're highly likely to sell them at a discount, unless if the existing current interest rates are quite lower. But on average, that's my only worry, that you might find yourself selling them at a discount. So my only advice is always hold them until maturity, unless of course there are exceptions. There's an emergency and this is the only thing you have, you can easily liquidate it, because remember, in less than 48 hours, you can always have your money on your bank account. So I don't recommend you liquidating it unless you must. It's always far better that if you bought a 10-year bond, you wait until the 10 years to get back your principal. Otherwise, at the end of the day, you might lose out, because you're quite likely to sell it either at a discount, or, for lack of a better word, at a loss. So if you want to sell your bonds, what's the process? Still the same way. You just need to approach your bank, tell them you want to sell your bonds. They will get you immediately a quotation on what they want to buy, because most of the time they're the ones who first buys them, then they sell them off to other people. If you're not happy with what with the price they're giving you, then you can still always consult them and see if there are better options available. But the best alternative, as I have said, is for you to wait it out. But if you can't wait it out, then you can always sell them off on the secondary market. And it's a very simple process. In less than 48 hours, you can always have your money on your bank account. But always be ready. In the event you're selling them at a discount or at a loss, then you have to just accept that. That's why, for me, I always recommend, if you're investing in treasury bonds, please go in if you're sure that if I have invested for 5 years, I'll wait until 5 years. If it's 10 years, I'll wait until 10 years. If it's 20 years, I'll hold this bond until 20 years. Otherwise, if you're selling them at discount, then it starts to lose sense, because remember, you're going to treasury bonds because you feel like it has a better interest rate compared to, let me say, a unit trust. But now if you're selling them at a loss, it means most likely you'll be shocked that the loss might again compensate for the interest you have gotten, whereby you're back to if you have invested in either interest or even worse off. So if you're investing in bonds, please invest for the things you are sure you can hold until maturity. Otherwise, I have said, you can always sell them in the event of an emergency, and you can always get back your money, or in the event you have gotten a better investment. You know that there are times whereby you have a better investment that even if you make a loss here, it's very, very okay, because what you're going to put money the other side is far, far better in terms of a return. And that comes to a sale. You just need to approach your bank, talk to them about you wanting to sell your bonds, and they should give you a quotation in the shortest time possible, and you have your money on your bank account in less than 48 hours. And this takes me to the final part. Okay, you have invested in treasury bonds and you have waited until maturity. Let me say you have invested for 10 years or for 5 years, and the 5 years have come. What happens to your principal? It's very simple. Bank of Uganda highlights when exactly you will get back the principal. So after the 10 years, or after the 5 years, after the 15 years, there is a specific date they will tell you that this is the day they will return your money. And on that specific day, boom, the money will be back to your bank account, and you'll be free either to use it for other things, or you can again reinvest it in other bonds. But this takes me to another highlight, and that's what we call the bond ladder strategy. I've been talking about it, but I can highlight it here. In this bond ladder strategy, it's where you invest in different bonds that mature in different months, but bottom line you're looking out for is you want to be earning interest every single month. Because remember, bonds pay every after 6 months. So if you invested every single month for the rest of the year in bonds, it means by next year you'll be earning interest twice every single month from different bonds. So if you want to make sure that, let me say this is your retirement package, you want to make sure that every single month you're earning interest, it's very simple. Just talk with your bank, make sure that you invest in different bonds, but they should be expiring in different months, and make sure that at the end of the day, every month you'll be earning interest. Because the moment they're expiring in different months for the rest of the year, 100% guaranteed, every single month you'll be getting interest from at least 2 bonds. So at the end of the day, my job is just to wish you all the best when it comes to investing. But please, if you're going to start to invest in treasury bonds, make sure that you are in for long haul.